Hello, everyone. I hope that we're doing well. Today, we're going to be looking at cash flow forecasts. Cash flow forecast. Um, Cash flow forecast really is very similar to a cash flow statement. However, why a cash flow statement, shows you the actual movement of cash over an accounting period of a business. The cash flow forecast and shows the anticipated movement of cash. Um, so that's the key difference between a cash flow forecast and a cash flow statement. Cash flow forecast is really very important for a business, especially at startup, and of course in the subsequent years as well. So at startup stage, cash flow forecast can be used to plan the capital requirements of the business. You're able to use it to, if for example you're anticipating a cash surplus, you'll be able to plan the investment of that cash, the likely investment of the cash. If you were anticipating maybe a cash deficit, for your business, and then you'll be able to, plan how you're going to be able to, get additional financing for the business, so that, your business doesn't fail or you don't, get some obvious challenges that will come with cash deficits. Cash flow forecast helps you to also, monitor the movement of cash flows that you have forecasted or that you have budgeted, against the actual thing that then happens when you actually start the business itself. Cash flow forecast is actually very important because cash is one of the major reasons that you see business failing. So it's important for you to be able to, plan ahead so that you're able to address every potential problems that could happen in terms of cash shortages. So it provides you with advanced warning of cash shortages that you might encounter in the business. Also, your cash flow forecast helps investors to know that you're a serious person. It provides that reassurance to them that the business knows what it's doing and the business is properly managed. So as a business, you're also having the assurance. So apart from your investors, having that form of assurance, it also helps you also to be sure that you can pay your suppliers, you can pay your employees as well. You're better protected in that sense. So it's an important part of financial control. We have a question here on cash flow, but key thing I want to highlight before we go into addressing this question is we need to be able to tell, what are the ways that, cash comes into the business in form of cash inflows, and what are the ways cash goes out of the business in form of cash outflows. So there are various ways that, money comes into the business. So we would be expecting cash to come in form of sales. So our sales, our cash sales, when we sell things to customers and customers bring money to us, we might expect money to come in from our debtors. So our trade debtors, or if we've sold things to our customers in a previous year, if we had a previous accounting period, and or even subsequently, we plan that we'll make some sales on credit, and subsequently, payment is being deferred to a later time in the future by our customer. So it means that money can come from our trade debtors. Money could also come into our business if we were to sell some of our fixed assets. Money could come in form of, if we have maybe invested the money we have in the bank, so maybe interest income, so we could have money from interest, or if we have rented out part of our premises, money could come out from rent income. We could receive some form of commission. We could get grants, so money could come in form of grants. Money could come in form of the bank giving us loan, so we could get money from loans from the bank, or maybe we have more investment or capital into the business. So those would be example of cash inflows into our business. Cash outflows, on the other hand, the expected cash payments that we're expecting to make. Maybe we have payments to our suppliers for the purchases that we have made. We might have to pay wages and salaries to our, our employees. Perhaps we're also buying fixed assets for our business. And, as we're starting or running our business, we purchase fixed assets, payment for those fixed assets. We might pay taxes on the profits that we have declared. We might also pay, since we said inflows could come into our business through loans from the bank. We might be paying interest on those loans or bank overdrafts that we have taken. It could be that, we're paying dividends to shareholders, so part owners of the business. It could be that we're repaying loan amounts. All of those could be ways that money leave our business. So all of those expenditures, all of those things that take money out of the business then would be the cash outflow of the business. Okay, so now let's go to this example and address the example. So the question says, Ajoke's Diva is planning to start a shoe shop called Jokes and Divas Limited on the 1st of July 2023 with 25,000 that she has inherited from her grandparents. She has found a suitable premise in the town center and has arranged for professional shop fitters to refurbish them. The new features and fittings will cost 30,000. So we've had here an initial 25,000, investment that we'll call capital, and then now we're having that we have furnitures and fittings, so that's fixed asset, purchase of fixed asset, which we have considered as a cash outflow, 30,000, but will not have to be paid for until September. So payment has been deferred in that sense. In addition, she estimates the following transaction will take place during the first 3 months of trading. And here we have a list of the transactions that will take place, within the first 3 months of trading. We have here revenue, cash sales. So if we have cash sales, we know that that's going to bring us, cash inflow into our business. We also have revenue credit sales. So, depending on when customer will be paying, we know that also brings in, money into the business. I think I could maybe increase this a bit. Okay, I could just leave that. Okay, and we have here purchases. We know purchases, takes money out of the business, so that's cash outflow. We have overheads, cash outflow, and we have salaries as well, cash outflows. So now let's see how we're going to, prepare our cash forecast. So the first thing I will do is to name our cash forecast. So we have here the business name being Jokes and Divas. So I'm just going to copy Jokes and Divas and maybe bring that here. Jokes and Divas. Jokes and Divas Limited. So what I'm preparing is I'm preparing a cash flow and a cash flow forecast. And it's for July. So July, and we're told 3 months. So July, August, September. So I'm preparing till September 2023. So we have that. We have Jokes and Divas, which is the name of the business. We're preparing a cash flow forecast for a 3-month period, July to September 2023. So what I'll first do is to, identify the month. So this will be where my transaction narration would be. So I'm going to leave that and I'm going to come here and put in July, August. I have here September. So these are the 3 months that I'm going to be forecasting, based on these transactions that, has been provided. So we're told that she estimates, the following transactions. So based on these transactions that have been estimated, I'm going to be preparing the cash flow forecast. I'm just going to put here the total. I'll put in the currency. So the currency we have here is in pounds. So I'm going to put in here pounds, just to be very clear. Okay, great. So now I have to put in my narration. I'll start with my cash inflows. Cash inflows. So I'm going to be looking at each of the transactions below and, try to put in which is my cash inflow. So here I'm told that it's planning to start a business, start a shoe shop called this 1st of July with 25,000. So it means that by the 1st of July, I expect to have an inflow in form of capital into the business, July 25,000. Great. Is there any capital in August? No, doesn't appear. So I have 0 the capital in August and 0 capital in September. The total money I have in, as capital is 25,000. So I have there 25,000. Okay, so the next transaction I hear the new features and fittings will cost 30,000. That will be a cash outflow. So what I will just do is I'll just leave a couple of lines. I'll anticipate some things here and just come in here and put cash outflows. And the first cash outflow I'm seeing here is that, you have purchased a non-current asset. So here I have furnitures and fittings. So if I just bring in furnitures and fittings, which is the first thing I'm purchasing here, furnitures and fittings. So you purchase furniture and fittings. Okay, and furnitures and fittings, I'm told the furniture and fittings will cost 30,000, but will not have to be paid for until September. So it means payment of this 30,000 will not happen in July. It would not happen in August, but it would happen in September. So I put in here 30,000. 30,000 in September. So we have nothing, no payment made in August and no payment made in July. Okay, so I come back down. It says, in addition, she estimates the following: revenue cash sales. So I have here cash sales, and I know that revenue cash sales brings in money into the business, right? So that's cash inflow. I bring in here cash inflow. And that amount is 10,000 per month. 10,000 per month. So I make 10,000 per month cash. In July, I make 10,000. Well, not me. Jokes and Diva, 10,000. And then here, 10,000. So at the end of the period, the cash sales would be 30,000. Okay. So here as well, the total furnitures and features we have is 30,000. Just gonna put that there. Okay. So the next thing we have here is revenue, credit sales. So we have here credit sales. I'm just gonna put this here, credit sales. But it says credit sales of 2,000 per month. Customers will have 1 month's credits. So 2,000 per month, customers would have 1 month's credits. Customers will have 1 month's credit. So what it means is that I sell 2,000 in July, but customers would not pay me in July. So I come in here, customers will not pay me in July, they'll pay me in August. So I have 2,000 for July and August. But it says it's 2,000 per month. It means that I also sell 2,000 in August, but customer would not pay me in August, they'll pay me in September. So I put that 2,000. I sell 2,000 in September, but customer would not pay me in September. They'll pay me in October, but we're not, forecasting for October, so I'll leave that. So I sum up that, 2,000 plus 2,000 gives me 4,000. So I put that there. Do we have any other cash inflow? Cash inflow, purchases? No, that's an outflow. Overheads and outflow. Salaries and outflow. So this is the total of, so we don't have anything here in July. This is what we have as inflow. Let's finish up the outflow. So we have purchases, 5,000. Purchases, 5,000. So I'm just going to put in purchases as an outflow. And we're told 5,000 per month. So I sell 5,000 per month. Well, Divas, Jokes and Divas sells 5,000 per month. Suppliers would give 2 months credit. So Jokes and Divas purchases goods 5,000 every month, but the supplier is giving Jokes and Diva 5,000 credits, meaning that in July, you're going to be purchasing 2,000. However, you're not going to be making 2,000 payments in July. Neither are you making it in August because you have 2 months, credits. You've been granted 2 month credits. So you're going to only pay in the 3rd month, and that 3rd month, you're going to be paying 5,000. You're going to be paying 5,000. So whilst also in August, you're going to be purchasing 5,000, but you have 2 months as well. So you would have September and October, and we're not forecasting beyond September. So there's no need, to do anything there. So the total purchases that you're forecasting for in that 3-month period then will be 5,000. Okay. The next thing we have here is overheads. So we'll pick our overheads. We're told 5,000 per month. So your overheads is 5,000 per month, and you're making your payment appears immediately. So you're going to be putting your 5,000 per month. And then in 3 months, that's 15,000. Okay, great. And the next one we have here is salaries. Salaries, so I bring in here salaries. And you have 1,005 per month. Yes, you're going to be paying your employees per month. So 1,005 per month. Here we have 1,005. Here we have 1,005 per month. And the sum of that gives us 4,500. 4,500 for the 3-month period. So now what we want to do is we want to sum, what we have across the months. So if we were to sum, so maybe what I could do is I could just sum up all of this. Right. So we want to sum that. So we have here 35,000. So if all we need to do is just to sum that. Okay, I could just leave that. You have here 35,000 because 25,000 plus 10,000 is 35,000. So in July, you're expecting to receive 35,000. You're expecting to receive 35,000 in July. And in August, you're expecting that you're going to have so we can make it bigger. You're expecting that you're going to have 12,000. You're going to have 12,000 in August. In September as well, you're expecting to have 12,000 in September, after summing that up. And total, at the end of the 3 months, we're expecting that 59,000, would have come into our business, into Jokes and Diverse business. I'm just going to make, center this bit of it. Okay. So what I'm going to do is I'm just going to do this and do this as well. So we have summed up, these bits. So maybe I just use that as okay. Let's sum up the cash outflows as well. Let's see the total of our outflows across the 3 months. Okay, so we see that in July, 6,500 outflows. We have 6,500 outflows in July. In August as well, we have 6,500 outflows, as well as 41,500 in September. So September we have 41,500 outflows. What we need to do next is we want to know what is our net cash flow. So what is the difference between what we're expecting to come into the business and what we're expecting to go out of the business, so that we know how much we have, are we going to be having a surplus? Are we going to be having a deficit? Do we need to make some plans as a result of the knowledge we have of of this information? So I'm just going to do this. That's right. Okay, so we need our net cash flow. I'm going to put here net cash flow. So our net cash flow is the difference between our inflow and our outflow. So the difference between our inflow and our outflow, so I'm just going to do 35,000 minus our outflow. So in July, we have 35,000 coming into the business. and we have, 6,500 leaving the business for, furniture, fittings, purchases, overheads, and salaries. In August, we're going to do the same thing. All we're doing is, the inflow in August minus the outflow that we're expecting to see in August, and that's 5,500. We do the same, 12,000 minus 41,000. It appears that in August, we are going to be, having a negative figure. We're having a negative figure. So I'm just going to ensure this in red. So you have that in red, or you put that in brackets, or you have, in minus sign there, just to show that, that's a negative, so a cash deficit in August. So we do not have as much money coming into the business compared to how much is going out of the business for the month of August. And all in all, we see that, the total of our inflows compared to our outflows appears to be, 4,500. So we have 4,500 cash surplus there. Okay, so after we have our cash, so we now know what our net cash flow is. What we want to know is the opening and closing balances. So we start by looking for our cumulative cash brought forward. So what is our cumulative cash brought forward? So our opening balance from the previous period. So we want to see what did we bring anything, from the previous period that we're, including in what we have for this period. Because what we have in our case, we were told in our case that, this is a new business. Ajoke Diva is just planning to start this business. It means we do not have anything coming from any previous period, because this is the first period. So put here 0. That is 0. But we know that, in August, we'll have something coming into August. We'll have an opening balance in August. And the opening balance in August will be the closing balance of July. So here our opening balance, which is our balance brought forward, would be equals to whatever we closed with in July. In August as well, in September as well, would have whatever we closed with. So whatever our closing balance is, in September is what we'll be having in whatever our closing balance in August is what we'll be having in September. But I'm going to just cumulative balance brought forward. So our cumulative, but in this scheme, is carried forward. So what we're carrying forward to the next period, so if I put that here, what we're carrying forward, we didn't bring anything, into the months. So it means what we have that we're taking as the closing balance that becomes the opening balance in August is this 2. Okay. So I'm just going to do that. And this 28,500 closing balance in July becomes the opening balance in August. So in August, we have 28,500 opening, the balance of August, in addition to the surplus that we're already, the net cash flow we have in August, and that gives us a closing balance of, what closing balance would that be? Of 34,000. So closing balance of 34,000 becomes the opening balance that we have in September. So we open September at 35,000, but we have a net cash of 29,500 in September. And then if we sum that together, that gives us a positive 4,500, a positive 4,500. And that's, what we have ended the period with, a positive 4,500. Okay, so that's that in preparing the cash flow forecast. So for cash flow forecast, then for divas is, so I could just, if I make that just bolder. So we know what we're expecting, in we then know what divas should be expecting for her own business. You know, we know what divas should be expecting for her business. So we have here 4,500. 4,500 surplus. So this business, you know, is not anticipating to have a deficit for the first 3 months of trading. So the question says that what is the interpretation of this? What is the interpretation? What is the interpretation of this? It says interpret the cash flow you have prepared and comment on the cumulative cash position on the 30th September 2023. So what this cash flow forecast shows is that, you know, if the estimates are accurate, if the estimates of what Jokes and Divas has done is accurate, all of these estimated transactions, if they are, if they are accurate, the business will have a cash surplus at the end of each month. So at the end of each month, if you look at the month, at the end of each month, there is a cash surplus. Even though, you know, a net negative cash flow is expected at the end of September, but the positive that comes in at the beginning of September makes, you know, the business to have a cash surplus at the end of the month. And then cumulatively, you know, the cumulative cash position would be 4,500 at the end of the 3-month period. So here you see the 4,500 positive cash position that is anticipated for Jokes and Divas at the end of the 3 months. At the end of the 3 months. So like we said, you know, at the beginning of trying to address this question, it is very important, you know, for Jokes and Divas to know how much, you know, if this was a cash deficit, for example, she would know that, okay, maybe she would need to invest more than 25,000 into the business, or perhaps she needs to plan to get, you know, an overdraft from the bank, or she needs to plan other alternative sources of financing and all of that. But in this situation, considering that, you know, we're anticipating a cash surplus, you know, this business looks to be doing okay. It looks as though, you know, she's better prepared. Now she's better informed of her own cash position and how she was going to run the business in the next 3 months. Okay, we'll stop with that. And then in subsequent videos, we'll try to address more interesting questions, more complex questions than this. I'll see you then. Have a great time, everyone.